HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.
The HSBC India Investment Summit, Alternative Investments and Global Markets, presented in association with CNBC TV 18, was recently held in the national capital. The event brought together industry leaders to discuss global and India perspectives, market trends, how alternative investments can play a vital role in promoting sustainable growth, manage risk effectively, and unlock new opportunities for investors. The summit's first session, titled Market Outlook for 2025, examined key economic trends, both from Indian and global perspectives.
What a context we're meeting in. India has just announced its economic survey saying that the Indian economy is likely to grow between 6.4% and 6.8% in this fiscal. What the economic survey has also called for is deregulation, deregulation, deregulation. And globally, of course, you've got Trump in the White House. The markets are watching all the developments very, very closely. We've seen what DeepSeek has done to the tech stocks in the US. So let me start off with DeepSeek, actually. William, we saw a lot of activity in US stocks over the last 2 years. Valuations were high. They performed well. A lot of concentration in technology stocks. DeepSeek has been a reality check. How do you think 2025 will be?
So, around the world, you're pointing the finger to the deregulation, and I think, I would add to that, obviously, the US initiative on the Department of Government Efficiency, deregulation. In Europe, the Draghi report that pointed to regulation being one of the big stumbling blocks for Europe, and the UK is trying to grow by deregulating as well. I wanted to start with a picture of, basically the global economic outlook, and I do think that we are in an environment where, we are at a good starting point for 2025. To come to your question around technology, yes, it is driving a lot of that growth. It has been driving a lot of that growth. The Magnificent 70 earnings growth has been quite significant. But as you can see on that chart there, where the earnings are accelerating is actually in the other sectors, and in part because they benefit from that technological improvement. Also those interest rate cuts, wage growth which comes down, which slows down, and therefore better margins actually pushing at new record highs. But I wanted to get into that question of the technology side and into the whole AI ecosystem, because clearly it's about much more than just chips. NVIDIA has been suffering around this, and I think that's fair because that is because of the concentration on chips. But what we've been talking about even before the DeepSeek news was that people need to diversify beyond the Magnificent Seven. And even in the AI bit, also beyond just the chips. Because when I look at the interaction in particular in the US, but in other countries that are trying to emulate this as well, it's that policy priorities and that innovation are reinforcing each other. Everybody wants to win. Every country wants to win in this area. And I know that India is taking some initiatives on this as well. So it's more than about chips. It is about the adopters of it. And if DeepSeek makes AI cheaper, the adopters are actually going to win. So I think you need to shift more towards automation, towards cybersecurity, and also towards, obviously, the electricity, the data centers, and all that is needed.
Absolutely. Diversify your risks. Now, when it comes to tariffs, Trump has been very clear, and we saw that in Davos. He said so many countries, Europe has been very unfair to us. He said that if the BRICS comes up with its own currency, we'll put tariffs on them. He wants to put tariffs on India. He wants to put tariffs on China. Any and everyone who has some sort of trade surplus with the US. But how is it going to come back and impact the US economy, number one? Because US companies don't like these tariffs themselves. And how do you see this impacting India?
So it will need to be a staggered approach. And you need to also distinguish between goods and services. Trump is obsessed with the goods, and it's much easier to put tariffs on goods than on services. The India case is much more a services-oriented exports that India does to the US. So that will shield it to a very large extent. As to how it impacts the US, clearly, as you're saying, it is if imports are more expensive, then that goes into the input costs for a lot of the production. So that goes either into into the margins of US companies, or it then turns out into inflation. If it is consumer goods, it bites into the pocket of the US consumer, particularly the poorer households, clearly, where it impacts them more. But the US is a relatively closed economy. It only trade of goods in the US is only worth about 20% of GDP. For the EU, that's 30%. For Canada, that's 58%. So it will have an impact, but probably more via the Fed policy than via real direct impact on the economy.
Abhilash, I'd like to ask you, now when we speak about global volatility, there is going to be no end to it this year as well. Diversification, de-risking from China has been a continuing theme. And the volatile geopolitical environment has made sure that the focus is on Asia. Now, within Asia, what are the pockets of opportunities that you see, and where would you place India in the pecking order?
Great question. So I think when we think about Asia, for the past 4 or 5 years, one thing that's been true is that it's been the global growth engine. But clearly, this engine is facing headwinds from the risk of tariffs. Now, obviously, President Trump hasn't imposed the 60% tariffs on China that he had sort of promised on the campaign trail. But as William alluded to, we are still not out of the woods, and the tariffs could come. So from our perspective, we think that Chinese policymakers will try to counteract those tariffs with fiscal stimulus, more government spending. But clearly, that is going to weigh on the asset markets there. However, when we think about Asian growth, and we are expecting around 4.7, 4.8% growth for Asia as a whole this year, most of that growth is being driven by private consumption. And that is a very, very important point, because what that means is that a lot of economies in Asia will be more insulated from the risk of tariffs. So we like economies which are more domestically oriented, which are more consumption oriented. India is one of them. Now, within Asia, there are 3 countries that we like, India being one, and I'm sure we'll talk more about that later on. We also like Japanese equities because Japan is well integrated in the whole AI, supply chain, both from software as well as hardware side. We've also seen, wage growth really accelerate in Japan, so that should boost consumption there. And apart from Japan, we also like Singaporean equities. So, Japan, India, and Singapore are the markets that we think should outperform within Asia.
Abhilash, my next question would be on FII flows. How do you see the trajectory in 2025?
Yeah, I think that's what a lot of investors have been focusing on, because if you look at the FII flows since late September, early October 2024, we've seen foreign investors pull out about $19-20 billion. Now, it's been driven by a combination of factors. So one of them is obviously profit-taking. Indian equities had a great run for the past 3-4 years. So the investors took some profits on those gains. But there's also been concern around, the growth slowdown in India and the INR weakness. And as you can see, that has had a big impact on the Indian equity markets. But I think that it's getting a bit stretched. And, this level of bearishness or this much outflows are not necessarily justified. So if you look at one of the factors that is commonly cited, which is INR weakness, the data doesn't support that. So what I have on the chart behind me is the return of Indian equities versus global equities, US equities, denominated in US dollar terms. So it adjusts for the INR weakness. And what you see on the right side of the chart is that Indian equities have outperformed global and US equities over the last 20-25 years, despite the INR weakness we've seen over the past couple of decades. Yes, in the last couple of in the last 5-10 years, US equities have done well because of the strong exposure to technology sector. But even in that case, Indian equities have outperformed global equities. And what that tells us is that while currency weakness is a factor to consider, what's probably more important for investors is the actual corporate earnings, the earnings growth that they get. And there, the strong GDP growth that India has and the superior return on equity that Indian companies offer mean that over a long period of time, Indian equities still have the potential to outperform global equities. And I think we are missing one important factor in this whole narrative around FII flows, and that's the domestic investor base. So in the last 4 or 5 years, we've really seen that domestic investors, especially retail investors, have become an increasingly important driver of the market flows. So if you look at just the SIP flows, they are at around $3 billion per month flowing into the markets, right? And we think that Indian households are actually underexposed to equities when you compare them versus US and European households. So we think that this SIB story and the strength in domestic investor flows is something that has legs to run. It can continue for the next few years.
Let me come across to Shriram now. Shriram, thank you so much for waiting patiently. We've seen, of course, global market volatility, a rate pause by the Fed. How do you see the global economic environment impacting fixed income markets going forward?
Sure. I think clearly, even a couple of months before Trump really came in, we saw the markets really pricing in all the risk to a large extent. You saw US Treasury yields move up almost 100 basis points. You saw the dollar index race towards closer to the 110 mark. But over the last 1 month, if you really see, actually things have stabilized a fair bit. So there is a little bit of a sense that maybe the bark was much worse than the actual bite. We are seeing the way the conversations are happening, a lot of it is negotiations. So as far as the scare that the global bond markets is a huge worry from our Indian interest rates perspective, I think maybe that needs to be kept in check somewhat. I think the global bond markets, now that levels are already fairly elevated, I think are at, one should consider it more from a neutral perspective and be open to both directions in terms of movement as far as interest rates and the currency is concerned. So I think that extreme panic of spillover of global onto the India side has ebbed, I think, to some extent. But having said that, clearly the volatility is going to be there. Things are going to unfold. We are going to see the pendulum swing again. And over there, what really needs to be kept in mind is the fact that the Indian macroeconomic situation is probably at its strongest. From a current account deficit, even with everything that's going on globally, you would still factor in a 1 to 1.2% current account deficit for the next year. Similarly, the fiscal side, I think the government has been extremely prudent. And even from a reserves perspective, despite some amount of drawdown, 12 years back, we were at $280 billion and falling. Now we are feeling bad about the fact that we have come down from the 700 billion that we were at. So I think the defenses are extremely strong. The ability of the Indian markets, especially from a bond and currency perspective, to withstand global volatility is a lot more. And I think that gives the central bank, I think, a lot of ability to really focus on the domestic requirements, which is basically inflation and growth. And I think that ability and flexibility remains.
Now, when you speak about inclusion of Indian bonds in global indices, what's going to be the impact on domestic markets going forward?
Yeah, I think global bond index inclusion has been a story now for some time. It's been a very good, strong, steady tailwind for our markets. We have seen about $18 to $19 billion come in so far since September 23 when JP Morgan announced that index inclusion. Subsequently, 2 other index providers have also announced India's index inclusion into their EM indices, which is basically FTSE Russell and the Bloomberg EM local currency index. So all put together between now and March 26, we think there is potentially another $15 to $18 billion yet to come. So the total index-related flows from 35 to 40 billion is broadly the expectation. And I think that tailwind is likely to continue. While we have seen, obviously, whenever volatility goes up, especially on US bond markets and on the currency, we have seen a couple of months wherein flows have been muted. But finally, these are all index funds. They are all real money, emerging market, index-driven funds. With India being a 10% weight, and the kind of volatility that other EM countries like Indonesia, Brazil, all of them are seeing, I don't think anybody would really want to be massively underweight Indian bonds or Indian currency. At best, they would want to be neutral or, in fact, even overweight at this time.
HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.
The HSBC India Investment Summit, Alternative Investments and Global Markets, presented in association with CNBC TV 18, featured an esteemed panel of experts. They took the stage for a session titled Breaking Down Alternative Investment Trends, Unlocking New Opportunities.
Manish, if I can begin with you, what's meant by private markets? Let's begin with that. What's meant by private markets and the options available right now to customers and investors?
So private markets by definition is something that's not public, that's not traded in the exchanges. as the previous panel mentioned, there are a lot more companies that are private as opposed to being listed or public. And the larger scale of those private companies gives a much larger, slate of opportunities, if you will. And those opportunities are into multiple asset classes and multiple risk return profiles. So say, when I say private markets, and if we talk about equity investments in private markets, there could be venture capital, which is basically taking more of a business model risk. Then there will be growth investments where the businesses are mature, business model risk is not there, but you're funding for growth. And then the third is the largest category, which is the buyout. So once the companies are mature, they are cash flow throwing, and there are opportunities to buy them out in a private market and create value. So that's the private equity side. And then there is similarly the real estate, the commodity, all kinds of things you can think that is not listed. So that's the private market.
Right. Shekhar, and that same question to Shamal, but when it comes to AIFs and private markets, what are some of the sectors that you're most keenly watching out for this year?
Thanks, Parikshit. I think as Manish said, the private markets is something which is not in public, and every asset class which is in public market, you have an option for that in private market, where the valuations can be very different. Be it debt, like you can have a private credit fund which will invest in various asset classes in credit, right from a performing grade to a special situation funds. You can have a real estate fund where you can do a kind of a equity, or you can have a yield funds actually. And thereafter, you have the venture debt and the venture equity, and as Manish mentioned, the other parts of the alternates which is there. So the bouquet is very large. Whatever is in public, you can mirror it in some form or other in the private markets.
All right, Shamal, now when it comes to the opportunity, you're looking at, we were just talking about the global economic environment being a little volatile. Of course, there's geopolitics at play as well. Considering where the economy is right now globally, how important do you think is it for investors to think of alternate investment funds right now?
So one of the key features of alternative investment is that it is mostly not very closely correlated to the traditional markets like equities and bonds. So whenever there's a volatility in the market, this kind of provides a way of hedge against those segments, because these are typically illiquid instruments, not really moving with the market as such. So to the extent it's a hedge. So as a part of the portfolio, it really makes sense to have something like this, especially in situations where so many macro events are happening within India as well as globally, which is impacting the markets here.
Right. Now, let's break it down a little further. We've seen a lot of activity in real estate. How do you see real estate as a segment growing within AIFs? Shekhar.
So just a data point, like real estate as a percentage of GDP in India is approximately 7%. And if you can take a guess what's in the normal developed world, it's about 15 to 16%. So it is one of the largest driving sector. If India has to do well, the real estate sector as a sector has to do well, because it drives demand in consumption of your core industries as well as employment. Now, in real estate, when you have to play, you have typically a commercial opportunity and a residential opportunity in terms of investing. In residential, you have options of investing as a developer in form of equity, or you can provide credit to that developer. And in commercial, effectively, what you can do, you can play through a REIT, or there is a SM REIT which has just come, which is a small and mid REITs, as well as you can also provide a yield fund where you can kind of own a real estate through a AIF structure. So effectively, in real estate, as an investor, if you're looking in an alternate segment, you can play all the classes, being a co-owner of a residential apartment, or providing debt to that residential apartment developer, or being in office space, being a kind of a investor to earn a yield as a rental income, which is a phenomenally attractive proposition. So all these things can be converted into a AIF structure where investors can come and participate in the entire asset class.
Right. Now, when we speak about private credit funds, Shamal, what do you think is the opportunity now in 2025 and going forward?
So India is in a very unique stage. So this private credit market was non-existent, especially on a fund platform till about a decade back. Private credit was always there. It was being done on a different platform. which is mostly leverage vehicles like NBFC, etc. What happened around 2012 is that we had a vehicle which was set up by the regulator, AIF, which really provided an optimal structure for managing a product like a private credit. Because you have to look at what are the key features of a private credit. Typically, the key features of this product is one, is that typically they will be, returns will be higher than a public instrument. Second important feature is that these are typically illiquids. So these are the two key features. And of course, there are other things in terms of where they go, what kind of financing they do, what kind of payment structures are there, what kind of collateral is there. But the first two features, which is return and the liquidity part, requires a certain specific vehicle. And the category 2 AIF, which typically basically involves a fund vehicle where there's no leverage possible, and these are closed-ended structure. So they take away the risk of a fund manager being forced to sell an asset because the liquidity does not exist, because that case you will not get a fair price. To the extent that that can be managed through the structure, this product provides a significant alpha compared to a traditional debt instrument, the returns that you get from a debt instrument, specifically in the current context where the taxation rules in India are pretty uniform for fixed income instruments.
Right. Now, when it comes to the private equity space, Manish, what kind of opportunity do you see? Are there certain sectors that you're most bullish about, most interested in, and you feel that there will be a lot of activity in India?
By definition, in private equity, we don't look at immediate, what is the immediate lookout for a sector. We look at more medium and long term. And, it's obvious that there are certain sectors that will create a lot of opportunities in the long term. But what happens in general is just not us that knows that. Almost everybody knows that. And many of those assets get priced in. So just to give you an example, we do know that technology is going to play an increasingly important role. We do know that power and energy is going to be very important going forward, given electrification, industrialization, data centers, you can tell. But many of these assets do get priced in, given the expectations of medium to long-term growth. So for us to create alpha, or to create a real, to find the difference between price and value, which is what all investing is all about, you need to start looking at the differentials. So for instance, or the derivatives of those sectors. So we start looking level 2, level 3 down of what are the ancillary businesses that will benefit from these long-term trends. And that's what we try and do across sectors. So we do know technology is going to be important, to answer your question. We do know that India is in a good part of real estate cycle. We do know that power and energy is going to be important. And we try and find derivative businesses that are going to be beneficial.
Thank you very much, Manish, Shekhar and Shamal, for that masterclass on AIFs. And I'm sure this will encourage a lot of people to invest in this asset class. Thank you very much for being with us.
HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.